Welcome back to another roundtable. My name is Adam. With me once again, I have Rusmin and Victor.
Hi everyone.
Thank you so much for joining us. And today we're going to talk about a Singapore REIT that has come down quite a bit in its price, and we want to have a look at that. All right. So we're going to talk about Digital Core REIT. So we talked about this REIT before, right, guys?
Yes, yeah. During this IPO late of last year.
Yeah. So it's a REIT that owns data centers.
Yeah, it was hot at the point of time. I still remember that there were a lot of people who were very interested to subscribe to this data center because last year was a year where all the tech company prospering, and data center is one of those companies that actually benefited.
Yeah, and I mean, it's still a growing industry. Data centers are still huge. It's a huge industry.
Yeah.
But somehow, Digital Core REIT has come down 35% from its peak. And that's quite a bit of a drop for a REIT, right? It's not like a tech company that's just like come down out of nowhere.
Yeah.
So I think the question, if you're watching this or investors who have shares in this REIT will be wondering what happened.
Yes, yeah. So I think first maybe we just do a quick overview of what Digital Core REIT is, what they own, right? So they are actually a US REITs, but listed in Singapore Stock Exchange. Okay, so they actually own about 10 data centers in the US and Canada. Okay, and most of their data centers are actually freehold. Right, it's something that we can only dream of in Singapore. Okay, most of the assets are usually leasehold. So being a leasehold data center is actually very, very lucrative, and their customer profiles are basically quite strong. Okay, mostly your hyperscaler, like your cloud providers are AWS and Google and so on and so forth. Right, and so far in the history, I think they have retained their customer quite well at 96%, and their occupancies also since 2012 has been all-time high, right, like 90%. Okay, which is considered a pretty good data center, although it's a bit old, okay, but who cares?
Because it's freehold.
It's pretty old, the data center. Some of them are built in 1970s, some of them in 1980s, okay?
Yeah.
But as long as you can install as long as your building don't collapse, I think that's fine, right? Because people don't really generally go to data center and shop.
Yeah. I mean, it doesn't have to look aesthetic.
Aesthetically.
Right? It just has to function as it's supposed to.
It's supposed to, yes.
And you mentioned that it's all freehold, right?
Yeah, mostly it's freehold, right? I mean, we're not going to talk too much about the Digital Core REIT, what they're all about. Again, you can go and watch the YouTube video that we've done before.
So we did a previous roundtable on Digital Core REIT. If you want to, you can just check it out on our channel. All right, I think we covered quite a bit during its IPO. Yeah. So I think, of course, now back to the question is why it's dropped 35%.
Yes, okay. So I think first, why they dropped is obviously because the REIT share price has gone up since the IPO, because the last time that we did the YouTube, it was before the IPO, and they were trying to IPO at 88 cents, right? And then the share price has gone up to as high as 120, where their yield is about 3.5% at the point of time. Okay?
So there's a lot of demand at that point in time.
Yeah. So I think earlier to this year, I think people were actually trying to buy this Digital Core REIT. So it has pushed up the valuation to a price where I think is too high. So correction is just part of the natural, things that happen during the stock market. It goes up and down, right? So, and then plus we are now in the bear market. So I think bear market, typically share prices across company usually will drop. Okay, so we are seeing a lot of US tech company prices not plunging. So this one probably will not be spared. Okay, but I think specifically more to Digital Core REITs, why the share price dropped, mainly because I think in April they actually announced that one of the 5th largest tenant actually defaulted. Not defaulted, but rather they actually filed for bankruptcy. Okay. So it's almost as close to going to default their rental. And this tenant actually accounted about close to 7% of their rental income.
Okay.
Right? Which is quite substantial. Okay, so the tenant name is of course SunGard Availability Services, which they filed for bankruptcy, right? But then the sponsor has agreed to actually step in, pay for the tenants.
All right, so I mean that gap that's going to be caused by this tenant leaving is going to be covered by the sponsor.
Yes. The sponsor basically will cover whole, all right, temporarily until the space got filled up again in the future, which I believe it will get filled up over the next few years. But then we don't know, right?
So it's likely to be a temporary issue, right? Because I think it will eventually be filled up, like you mentioned.
Yeah. I think it's likely going to be a shortfall. Okay, which I think they already mentioned that it doesn't impact the DPU.
Yeah.
Okay. So which is good, right? So they basically come in and help to stabilize the DPU, financial engineering, I would call it. Okay. But then if you look at another reason why the company share price the REIT share price has been dropping, mainly because of the higher interest rate, right? So I think late of last year versus first half of this year, there's a big shift in changes when it comes to interest rate. In June, I think Fed had announced they're going to increase. They actually rate the hike by 0.75%. Okay, and by the end of the year, we can expect that the Fed rate will probably hover above 3%. Okay, which again will put in a lot of pressure on their borrowing costs, right? So, and according to their IPO prospectus, I think Digital Core REITs actually expect they actually forecasted that their weighted average interest rate for the year of 2022 is actually 1.4%. Okay. As of now, their loans when they first IPO, none of them are actually fixed. Okay, they are
they were all floating.
Floating,
yep.
yeah.
Okay.
So then, of course, they try to fix it along the way, and they have successfully done it in the first quarter, and they only managed to fix half of the loan.
All right.
Okay, but then that is actually at a higher borrowing cost. Okay, at about 2.1%. Okay, so that the other half will be exposed to the floating rate, which now we are seeing a surge of interest rate, and that will put in a lot of pressure on their borrowing costs, and that will cause them to be become very difficult to deliver the DPU that may promise in this year.
Yep. And also I think the Fed is likely to increase the interest rate again. I think this coming July, which also may affect their distribution again.
Yeah. I mean, look at the mortgage rates. I mean, just in Singapore, right? The headline rates for mortgage
local banks fixed rate already went up to 3%.
3%. Yeah. So I think everyone can feel it.
Yep.
I think the REIT is no different. But I think it's interesting because I think we've covered a roundtable on interest rates and REITs before, where we kind of like correlated whether interest rates actually affected REIT prices.
Yes.
And if you go watch that roundtable we did previously, there was actually no correlation. I mean, there was a positive correlation. When interest rates went up, share prices went up as well. But I mean, there was a selection of REITs that we picked, the older ones with a longer track record. And there were a few reasons why that happened, all right? Because in general, interest rates do affect REITs.
Yeah.
But in this case, it seems to look like Digital Core REIT is affected by interest rates quite a bit more.
Yes.
Yeah, and it's because of the floating rates that they have.
Yes.
It was 100%.
50% for now. Okay,
for now,
because
but
before that was close to 100%.
Okay.
But I think there's always a lagging effect on this. When their interest rate costs start to come up, they have not passed the cost down to tenant. Probably you have to take a few months or a year to pass it down.
Because the rates will go up before you can re-rate your contracts with your tenants.
Yeah. So you look at the rental structure, they have weighted average lease to expiry at about 5.5 years. So I think most of the tenants actually agreed to pay a step-up increment about, I think, 2% on average, according to them. But then 2% may not be sufficient, right, to cover that kind of higher cost of debt that we are looking at right now. Okay, because Fed actually front-loaded all the interest rate in the first half of the year itself. Okay, so I mean, these are the negative news that affecting the share prices. And of course, the other one is it could be the recent news that gym channels right. Basically, he actually announced that he's going to start a funds to short all the data center REITs in the US. Right? Okay. So that could be also the impact, cause the prices to drop even more. Okay, and because he's saying that a lot of the big tenants of data center is actually your big three, your Google, your Microsoft, and your Amazon, AWS, and they actually have a more bargaining power versus your traditional data center REITs. So he's actually betting that in the next few years, the data center like Digital Realty Trust, which is a sponsor of Digital Core REIT, and Equinix may not be doing so well. Okay, which I disagree, right? But I do agree with him that the valuation was high at one point of time, okay, and that's why it's due for correction. All right. Yeah.
So all these factors put together basically have pushed Digital Core REIT down 35% from its peak. I mean, first of all, it was, you probably said, overvalued at its peak.
At its peak, yeah.
And then put all the factors together, interest rates, the fifth largest tenant leaving town and all this stuff, has basically spooked investors here.
Yeah, those are the big surprises. That's why I think this REIT is supposed to be stable, but then it's behaving like it's another growth stock. Right? The share price crashed 30%.
So I mean, when I think I've noticed on our channel anyway. Anytime a stock comes down, we talk about it, and we find out whether it's good or bad, temporary, or maybe something that we should avoid. When stocks go up, we don't really talk so much about it. So this is another example of things coming down. And we want to find out whether there's an opportunity to have a look at it. So what do you think of this one?
Okay, so as of the time of this recording, the share price have crashed to about 75 cents from its previous height a peak of about 1.2.
Okay.
Right, so I think based on their forecasted DPU, assuming that they can hit, I think you are looking at yield about 5.5%.
Okay.
Okay, I'm basing on their forecasted DPU of 4.18 cents. Okay, so again, this counter is traded in US dollars, so even their DPU is also paid out in US dollars. But of course, if you're a Singapore investor, you may receive it in Sing dollar. They will convert it for you, right? So and so the yield now is about 5.5%.
Okay. What do you think? Is that decent? I mean, some people will be really happy with 5% yield, but do you think they can maintain their dividends?
I think if you're happy with 5%, maybe there's still a high possibility that they can maintain it. Okay, even if the DPU were to drop, right? So, but then it's not the end; it's the beginning of the pressure where you're looking at for the higher borrowing cost. Okay, so I mean, for other REITs with track record, I have no issue, considering it as an investment. But this REITs is relatively new in town. Okay, so I think as our usual approach at 5%, you usually monitor them for 2, 3, 4, 5 years. Okay, before we actually consider them. Okay,
I think as much as they have very good sponsor with very good track record, but at the end of the day, is probably we should treat it like a separate company, reevaluate whether the fund manager is aligned, whether because there's still a lot of assets they're going to pump into the digital core REITs right in the future. We want to see how is the way they structure the deal, whether it's shareholder friendly or it's not shareholder friendly. You never know. Maybe become digital core REITs may be a dumping ground. You never know for them for sure, right?
So they could be. I mean, you're just basically saying that you have no idea how they're gonna manage it.
Basically whether they're going to do yield accretive acquisition.
Okay. So we need every time I think one of our big philosophy is we need to be very comfortable in the manager, right?
Yep.
At the end of the day, investing is about sleeping well. If you invest in a manager that they always want to take advantage of you, then I can't sleep well at night, right? So that's the reason why we usually those IPO REITs, right? We'll usually track them for a few years before we decide. Same for Capital DC REITs. We track them for a few years. We think it's okay. Yeah. So now they are in our okay list, right?
Okay.
Yeah.
So naughty or nice, yeah.
Yeah.
All right.
So I think we look at the Eagle Hospitality Trust. I mean, that's one of US REITs that got listed, and then
so that one was naughty.
Bust.
Yeah.
A lot of people were asking us to look at Eagle. I remember at the point of time.
Yeah. So.
All right.
Yeah.
All right. So 5.5%. So you're saying that, I mean, because you want to be a bit more conservative. I mean, the sponsor has a good track record.
Yep.
Yes.
But this one, you still want to observe some more because this is the way you invest.
Because the way I see it, with the share price plunging, I think it makes it very difficult for them to acquire those properties that belongs to the sponsor. I mean, sponsor already promised 10x of their property value, which is about 15 billion to be injected over time. But the cost of equity actually has gone up because of the lower share prices.
Right.
Okay,
so what I mean, usually when you invest in something, you also want to look at adjacent investments, not just because this is not the only data center REIT out there, right?
Correct. Yeah.
So if you compare it to the Keppel DC and
then Mapletree Industrial,
what are the yields like?
They are at this same point of time. I think the Keppel DC is about close to 5%. Mapletree Industrial is about 5.3%.
So they're pretty comparable in terms of yield as well, and they have a longer track record.
Yes. Yeah.
All right.
Yeah.
So in that sense, maybe an investor like you may prefer something that's more.
Correct. Keppel DC. I'm looking at Keppel DC, but just looking for a higher yield.
All right. Yeah. So because the yield isn't like 7-8%, which makes you maybe consider, okay, maybe I'll take that extra yield for the extra risk.
When it happens.
Yeah. Okay. So
we just pray for hope that all the data center continue to drop.
Okay, so then you can start picking up some that you really, really like.
Yeah.
Okay.
Some people will like, oh no, I want a lot of data center REITs.
All right. So I guess the question of whether would you buy Digital Core REIT is probably a no.
We will just
observe, right?
Observe, yeah.
All right. So again, no recommendation to buy or sell anything. We're just having a look and finding out the reasons why, this has come down and whether there's an opportunity. Do your own due diligence as well. Yeah. So anything else about Digital Core REIT? Pretty much it, right?
Yeah, pretty much.
All right, so there's a pretty good summary of Digital Core REIT, especially if you're a shareholder or if you're looking to invest in them. We hope this roundtable was a good summary for you. So once again, my name is Adam. That is Rusmin and Victor. Thank you so much for watching. If you like this roundtable, please hit the like button. Of course, any questions about Digital Core REIT, feel free to ask them in the comment section. And of course, subscribe to our channel. Many more roundtables coming up, and we love to see you again.